if tomorrow, in the middle of a real emergency, you try to transfer money from your emergency fund and your bank informs you that your account is temporarily blocked for an internal review? Your money is still there, but you cannot use it. That is not financial paranoia. It is an operational possibility within the modern banking system that many people simply do not consider. There is a very popular narrative on the internet that says, if you have 6 months of expenses in a savings account, you are protected. That phrase is incomplete. In today's financial environment, saving the money is only the first step. The real question is your liquidity truly protected? Today, we are not going to talk about how to save. We are going to talk about financial architecture. We are going to analyze how to protect your emergency fund against 5 critical points: custody risk, loss of purchasing power, digital dependency, confusion between investment and reserves, and regulatory changes. Because in personal finance, it is not enough to have capital. You must guarantee access, stability, and resilience. This content is educational and seeks to encourage strategic reflection. It does not replace personalized financial advice. If you value the stability of your family, this analysis is for you. Here is the first critical point. Concentrating your entire emergency fund in a single financial institution creates a single point of failure. The banking system is solid in general terms, but solid does not mean infallible. In the United States, the FDIC protects deposits up to certain limits. In Europe, similar mechanisms exist. In many countries in Latin America, there are also guarantee schemes. However, these mechanisms are not automatic switches. In case of intervention, review, or operational problems, access can take days or weeks. And in a real emergency, time is more valuable than any interest rate. Let us imagine the case of Robert, an architect disciplined with $30,000 in a digital bank. One Friday, he suffers a domestic accident. The system detects a transaction considered unusual and temporarily blocks his account for security. He spends 48 hours without access to his liquidity. He did not lose his money, but he lost control over it at the most critical moment. The difference between net worth and liquidity is enormous. Liquidity is not seeing a number on a screen. Liquidity is being able to use the capital when you need it. From a risk management perspective, redundancy reduces vulnerability. Now let us talk about something less dramatic, but equally dangerous. Your fund may be intact in nominal terms and deteriorating in real terms. Inflation is not just a figure published by statistical agencies. It is the real increase in the cost of living. Health insurance, housing, food, energy. Sarah saved $15,000 4 years ago. At that time, it covered 8 months of expenses. Today, it covers 5. The balance is the same. The purchasing power is not. In some countries, the erosion is moderate. In others, the devaluation can be abrupt. The emergency fund is not designed to seek aggressive returns, but it must preserve purchasing power within prudent parameters. Periodically reviewing the relationship between your fund and your real expenses is a responsible practice of financial planning. We live in a highly digitized financial system. That is efficiency. But it also implies technological dependency, server failures, defective updates, automatic blocks for security, temporary interruptions. They are not frequent, but they happen. James was traveling for work. A technical update generated a temporary interruption in his bank's card validation system. He could not pay for his hotel for several hours. He had money. He did not have access. A robust emergency fund considers operational risks, not just financial ones. It is not about distrusting the system. It is about understanding that no system is perfect. Diversifying methods of access to your liquidity is a practice of financial resilience. This is one of the most common mistakes made by people with an investment mindset, trying to make the emergency fund work. The emergency fund is not a growth portfolio. It is a stability mechanism. Elena decided to invest her $20,000 of reserves in an index fund to optimize performance. The market fell 30%. Simultaneously, she lost her job. She had to sell at the lowest point. What was $20,000 became $14,000, just when she needed liquidity the most. The emergency fund is not designed to maximize return. It is designed to prevent you from liquidating strategic investments at the worst possible time. Clearly separating investment and reserves is a structural decision, not an emotional one. The last risk is structural. Financial regulations evolve constantly. Changes in verification policies, updates to withdrawal limits, additional documentation requirements. Marcus had his savings on a platform that updated its terms following new regulatory guidelines. Temporarily, he could only withdraw limited amounts while additional information was verified. It was not fraud. It was not illegal. It was a regulatory adjustment. The architecture of an emergency fund also involves considering jurisdiction and the legal framework. Not from alarmism, from strategic planning. Your emergency fund is not a number. It is a structure. Real financial security depends on 5 pillars: immediate access, preservation of purchasing power, custody diversification, separation between investment and reserves, and regulatory awareness. You cannot predict the next crisis, but you can design your financial architecture to resist it. As Howard Marks said, you cannot predict the future, but you can prepare for it. This content is strictly educational and does not constitute financial or legal advice. Decisions should be made considering your personal situation. If this analysis helped you see your emergency fund from a more strategic perspective, subscribe and share this video with someone who still believes that saving is enough. Here, we talk about finance with depth. I will see you in the next analysis.